Imagine checking your investment app one morning and discovering your savings have disappeared. You refresh the screen, blame the internet, maybe even restart your phone. But nope, no technical glitch. The money is genuinely gone. And the worst part? You may still owe the bank. That nightmare hit more than 300,000 young Korean investors when South Korea's stock market suffered a brutal collapse. So, how did things get this bad? The story begins with AI. By 2026, artificial intelligence had become the hottest investment theme on the planet. But AI doesn't run on magic. It needs enormous computing power, and that requires advanced memory chips, especially HBM, or high bandwidth memory. South Korea was sitting right in the middle of this technology boom. Two companies, SK Hynix and Samsung Electronics, became incredibly important. SK Hynix controlled roughly half of the global HBM market, while both companies attracted massive amounts of investor money. By June 2026, these two giants represented around 50% of South Korea's Kospi index. That created a strange situation. An investor could buy what looked like a normal Korean index fund, but underneath it was essentially a giant bet on two companies, and therefore a giant bet on the future of AI. Young Koreans quickly jumped into the market. Many were already dealing with expensive housing and a difficult job market, so stocks appeared to offer a faster route to wealth. And they had reasons to be confident. During the 2020 pandemic crash, many young Korean investors bought stocks while foreign investors were selling. Some made huge profits. So when the semiconductor and AI boom arrived, many thought, why not do it again? Then leverage entered the picture. In May 2026, regulators approved new single-stock leveraged funds, including products connected to major companies such as Samsung. These products could potentially deliver twice the daily movement of the underlying stock. Sounds fantastic when prices rise, but leverage has a dark side. Young investors began borrowing heavily to invest. Retail margin debt reached record levels, with loan balances climbing to around 30 trillion won. The market looked unstoppable. Unfortunately, markets have a funny habit of proving that sentence wrong. The real trouble started when the money behind the Korean stock market boom began moving in the opposite direction. Foreign investors had been heavily involved in Korean technology stocks, but suddenly they had other places to put their money. One major catalyst was the highly anticipated SpaceX IPO, which attracted enormous demand. Global investment firms needed cash to participate, so some began selling Korean technology holdings. Then came another major development. On July 10, 2026, SK Hynix listed on the Nasdaq, raising more than $26 billion in the United States. For SK Hynix, this was a huge success. For Korea's stock market, however, it created an unexpected problem. American investors could now purchase SK Hynix directly using US dollars instead of going through the Korean market. In other words, some of the money that previously flowed through Seoul suddenly had another highway to take. Meanwhile, Korean retail investors were still heavily invested, and many were using borrowed money. This is where leveraged funds became dangerous. A normal index fund simply owns a collection of stocks, but leveraged products use complicated arrangements with banks to deliver amplified daily returns. A fund promising 2 times the daily movement has to constantly rebalance its positions. If SK Hynix falls, the leveraged fund doesn't just sit there hoping for better days. It has to reduce its exposure. That means selling shares. And when thousands of investors in financial products are forced to sell at the same time, the market can become its own worst enemy. By early July, one SK Hynix leveraged product had grown to roughly $13 billion in assets, making it the largest product of its kind globally. The problem was becoming obvious. SK Hynix's price was no longer being driven purely by semiconductor demand, AI growth, or company earnings. Mechanical selling was starting to influence the stock. Then, the price began falling. And once the decline started, leverage turned every small drop into additional selling pressure. The market wasn't simply falling anymore, it was feeding on itself. Then came the day investors would remember for a very long time, July 13th, 2026, Black Monday. The selling suddenly accelerated. Banks began demanding repayment from investors who had borrowed money, but many young traders simply didn't have enough cash. Some accounts were seized, while others were forced to sell their stocks at whatever price the market offered. And once those forced sales started, they created even more selling. It was basically a financial domino effect, except these dominoes were worth billions of dollars. As futures and stock prices plunged, Korean exchanges activated emergency circuit breakers. On the KOSDAQ, a sell-side circuit breaker was triggered after futures dropped more than 6%, temporarily stopping program trading. Later, the KOSPI also triggered another circuit breaker when KOSPI 200 futures fell more than 5%. The market became so unstable that trading was halted repeatedly. The KOSPI eventually plunged more than 4%, closing around 6,500 $16.27, while the broader decline approached 9%. Meanwhile, SK Hynix fell around 15% and Samsung dropped about 10%. But the damage wasn't limited to professional investors. Some retail traders actually bought more during the collapse, believing they were getting stocks at a huge discount. The classic buy the dip strategy sounded great, until the dip kept getting deeper. By the end of the week, more than 300,000 retail accounts had been wiped out, leaving many investors with devastating losses and additional debt. And the government couldn't simply watch the financial system burn. On July 16th, regulators suspended new leveraged funds after repeated circuit breakers. They also introduced emergency measures. The minimum cash deposit required for trading was tripled to 30 million won, roughly $20,000, while substitute collateral such as stocks and bonds was removed. Regulators wanted actual cash available for settlement, but critics argued that the government had helped encourage the very products that were now causing the crisis. And for many young investors, the damage was already done. The Korean crash didn't stop at Korea. It raised a much bigger question for investors in the United States. Could the same thing happen there? The warning signs were already visible. South Korea had become heavily dependent on a small number of technology companies, while the American market had developed its own concentration problem around the biggest tech giants. Then came another pressure point: the semiconductor industry itself. Investors began asking whether companies such as SK Hynix were shifting capacity toward lower-margin memory products and away from extremely profitable AI chips. If that trend continued, it could suggest that expectations surrounding AI demand were becoming less optimistic. And this matters because America's biggest technology companies are deeply connected to the AI boom. The so-called Magnificent Seven have become major sources of investment capital for the semiconductor and AI ecosystem. Huge cloud companies are spending billions on AI infrastructure, while chip makers are selling them the hardware needed to build it. It's a fascinating relationship, but also a potential vulnerability. If AI profits don't grow quickly enough to justify enormous spending, investors could suddenly start questioning those massive valuations. South Korea had already shown what happens when three ingredients come together: concentrated investments, borrowed money, and extreme optimism. The situation became even more painful for younger Korean investors. More than 1.2 million retail investors faced margin calls and forced liquidations, while people under 30 reportedly represented more than 60% of liquidated investors. The lesson is brutally simple. Leverage can make profits look brilliant during a boom, but when the market turns, the same mathematics works in reverse. South Korea's AI stock collapse wasn't just a story about one country's market. It was a warning. When AI hype meets concentrated bets and borrowed money, the exit door can become very, very small. And that's how an AI-powered dream turned into a financial nightmare faster than you can say, buy the dip. South Korea's crash is a serious warning. When hype, debt, and leverage join the same party, somebody eventually gets the bill. Could America be next? Well, that's the scary question. So if you enjoyed this breakdown, hit that subscribe button, because the next market surprise might be even crazier.